Positive surprise for us was James Hardie. We've owned James Hardie for a few years now, and although we knew there would be some recovery to housing starts in the US, which is their really shining light division for Hardie's, it's come in obviously a lot stronger. So the property market in the US is very strong. Similar drivers to what we're starting to see here in green shoots in Australia as well. So housing starts are the highest since 2006 in the US now. So that was a very good result in terms of sales growth, but also margin expansion. If we look at, again, the opportunities that we have in large cap 2 years ago, Hardie's in February 19 was somewhere around $17 a share, and the market was looking at business as a cyclical building materials business, whereas we saw it as a structural growth story, as fibre cement takes market share in the US, as they penetrate that market. They had the ability to grow sales independent of what was happening with housing starts. And then from an efficiency point of view, we saw some improvement there in their margins as well, as they convert those sales to higher EBIT margins as well. So, now we've been lucky enough that there has been also that recovery in volumes, but it's doing the work on the core drivers of revenue and expenses to identify where there's maybe the market is underestimating the growth potential of that business, and that's a classic case of that 2 years ago versus where we are now. In terms of what we own, Origin has pre-announced their earnings at the time as we speak. It's Turkey Energy Market, so that's been a challenging division for them in the short term, where we see that longer term. But there's a slight miss there, and that's probably an area of disappointment. But at this point, we're actually reasonably happy. We've had some very good results from Hardie's, I mentioned, from Macquarie, from Virgin Money, from Amcor, some core sort of positions for us. So fingers crossed, it's going reasonably well for us. A little bit boring, but Ramsay Healthcare. So with healthcare, you're really looking at that defensive earnings profile, and Ramsay, being a private health provider, does have a history of very good long-term growth in revenues. They've got that demographic support in terms of population growth as well as ageing population. But they have been impacted by COVID, which has really provided an opportunity for us to buy Ramsay at what we think is a discount to its long-term intrinsic value due to that short-term COVID disruption. So, they've had, in some instances, a lot of their hospitals have been shut, or they've been helping governments with dealing with COVID, particularly in the UK and France. And so, elective surgeries, they haven't had that come through. They've had elevated costs. So this short-term uncertainty for us is providing that longer-term opportunity to buy a quality business. So we'll be interested to see, particularly for domestic Australia, as we've done a little bit better from containment point of view, how strongly is elective surgeries coming back, because there will be a huge catch-up in demand there, we think, for elective surgeries as well. So that's one to watch, we think, for us, to see if that thematic is right and that Ramsay's well positioned for that recovery.